Ladies and gentlemen, welcome to the Capital Flows live stream. We have a really interesting live stream today going over the most recent comments by Kevin Warsh. And the changes that I think are beginning to take place are already at the top of mind for everyone. And so we're going to be covering a full breakdown of every single thing that Kevin Warsh said yesterday, how it connects to the larger macro regime. And what I'm really going to do in this session is give you an entire playbook and breakdown and framework for all of the comments that he made and how that would change or connect to the Fed. So myself and James will be going over that in today's stream. As a reminder, everything is laid out on the Capital Flows Research website. If you are not already a subscriber, go to capitalflowsresearch.com. Everything is laid out there, and you will get the entire slide deck and presentation that we go over today. That will be at capitalflowsresearch.com after this stream. So if you want the slide deck, all the models that I go through, everything like that, it'll be laid out on the website. And then last night, I sent out a positioning report on the real estate market explaining how it connects to the dispersion that we are seeing. And let me just zoom out for a second to give you the context. And then, James and I are going to really dig into the changes in Kevin Warsh. My entire goal is mapping the macro regime and running home run trades. It's very simple. I have no interest in this entire world of trying to benchmark about against the S&P 500 and thinking I'm having a good year because I outperformed the S&P by 2%. Just sounds like I should just go home if I'm doing that. My entire goal is to take massive asymmetric bets. And if you have been following along on the Substack, you know that my two largest bets right now are Per and Oracle. And I'll link this report in, you can go on the website and go to April 14th, when I did an update on Per and Oracle. All of these have been laid out for subscribers. So if you've been following along, if you've been on the live streams every day, if you've been a subscriber on the Substack, you know all of this. You know the breakdown for Per and Oracle and how, in my view, they are the most asymmetric opportunities in the market right now. And we are beginning to see that come to fruition. I laid out the Oracle long down at the 155 level. We are now at 187. And the entire point is that we are seeing sector, market, and fundamental flows put a massive bid in Oracle. And now everyone is just beginning to talk about it. And so, the view that I laid out here, and, we bid down just a little bit on, again, almost nothing. We held this level, and we stayed within the risk reward that I shared. Again, that was on the Substack. Everything is linked there in this report.
Could you add to that chart the flow indicator about the what I'm talking about, the sector, fundamental, whatever, just so people have a good context of what you're talking about?
Totally.
Yeah. There we go.
So here is, and you can actually get this indicator right here. So if you, let me see. Yeah, so if you just go right here in this report, again, just scroll to April 14th. That's when this article was written. Go to Oracle model, click on that. When you click on that link, it'll open up this exact chart, and you will have this. Notice that sector flows in orange and fundamental flows and broad market flows are all pushing it up. That's critical because what we are seeing right now is a combination of multiple flows pushing the price action up. This is how we actually break down the underlying drivers of a stock. And, people who are coming into the market and just focus on fundamentals, just focus on broad market or something like that, they're going to get sidelined when you have massive divergences to take place. So, for example, you have to recognize that you're not the only person in financial markets. When you begin to think that you're the only one who has a good idea, you're the only one you need to account for, and you begin to say, oh, there are passive flows, there are sector flows, there are hedge funds, there's equity long short, there's all of these ETFs. There's all of these different flows. And once you begin to connect your views and stack those to those specific flows, then you'll be able to actually have views that have validity in them. And you'll be more informed in your risk-taking process. And so here is the model that breaks this down. And you can, again, go to this model. The entire point of the Substack is you literally get all of these models and the research and all the breakdowns. And if you show up to the live streams every day, again, these live streams will be every single day, 8:30 a.m. Mountain Standard Time. You'll be able to get all of these breakdowns, and you'll be able to follow along with every single thing that's happening. And on top of all of that, right here, if you click on that model, this is the code for this model right here. So if you're a bit of a nerd and you say, oh, you know what, I want to make this my own process, you can just copy and paste this into Claude Code, and you can make something better than even I've shared, right? And that should be your goal. You say, oh, you know what, I actually have this other idea. I want to put this into Claude Code and overlay this with another thing that I have. Then I want to write a Substack article, and then I want to post some tweets, and I want to go through some of this stuff. And you can tag me or not tag me, or you can do whatever you want. You can go take that indicator and you can go sell it to someone else if you want to. You can do whatever you want. My entire goal.
I just want to point out, so people can visualize this. Just can you move the chart a little bit? But yeah, if we could move that box at some point, that would be great, because it's like maybe to the left or something. But if you scroll back, just so you can see where we're at now and where it had its previous run, you could really start to build an idea of what's possible with those flows, right? Like, because if you only saw the last couple months, you might think, oh, it's getting overheated or whatever, right? Like, but if you go back and you see where Oracle went on that legendary run, you can see how crazy the fundamental and sector flows can really get, right?
Yep.
So like now you have a little bit more, just another notch of the belt of how you want to maybe manage the risk, or where you would price targets, or what the potential of it would be by just visually seeing that, you know, like
Totally.
that direction looks so good right now. And there's by no means, in our eyes, I think, overheatedness. It's just building here.
No, to be very clear, I am holding the position that I have, and I am still very bullish in Oracle, and I haven't sold a single share. I'm also very bullish on PER, which continues. You know, I've been laying out PER for a very long time now, since, you know, basically since this level, these levels right here, when I shared this with paid subscribers and we began to bid. We're up, you know, almost 100%. It's been my largest position. I've been very vocal, very clear about it being my largest position. We're up 100% from that, and I haven't sold a single share. Why? Because the risk reward is still skewed to the upside. This is the entire point about taking risk and being a risk taker. You know, people will say, oh, well, you know, now it's contributing so much volatility to my portfolio. And, you know, even though they're on sides 100%, and they can say, you know, you could just put your stops at, you know, 450 and say, okay, that's my risk. And people will say, oh, it's still moving my portfolio too much every single day. I need to take away from my winner. I mean, just taking from, you know, my entire goal is to add to winners, not take away from winners. If I get on sides, you know, then I want to add to winners. And again, that's very difficult for people, because then that means that you actually need to know what you're doing. And if you don't know what you're doing, then that volatility in something that you don't have conviction in will 100% shake you out. Volatility exists to take money from the weak and give it to the strong. And that is always going to be how the market works. And so, again, these two bets were laid out in, I mean, you know, I laid out these bets in the respective times that I just noted at the levels, but this most recent article breaks down the thesis for them, and you can watch the entire video that I did on both of them. And we continue to move in lockstep with those views. So you can go through all of these. Let me just take this and put it in the chat here.
While you're doing that, I also think that one of the big sticking points for a lot of people is they'll see you say that, right? And they'll say, yeah, bro, but you got in at like the lows. I didn't get in. So therefore, what's the point? Right?
Yeah.
Well, I'm a good example of that, right? Did I get, like, we talk every day. Did I get the same entry point as you? No. Right? Did I take the same size as you? No. Did I, you know, do I have different risk tolerances and time horizons than you. Yeah. Right. But this goes back to the whole like betting on yourself or like taking accountability. It's like by somebody say like, well, you got that price, I didn't, therefore I'm out. Not only am I out, but I want you to fail now because I don't want to, miss it. But like, that's again people projecting this idea of like not taking responsibility, right? Because I said, okay, I understand what Global Flows is talking about. I sit well with this idea. It actually fits into what I have conviction in, where I spend my time, whatever. Now I have to then take that with a grain of salt and say, how do I fit this into my life? Where am I going to make it work? How much risk do I want to take? What are my goals with it? And then go from there. You know what I mean? You can't just rely on somebody else to just like make all this for you, right? That's kind of your whole point here is like, yes, you're going to put out all this information, but like when it comes to like fucking boots on the ground, like putting the money to work, you're not going to get the same entry points. You're not going to hold trades for the length of time. It's going to rebalance your portfolio in different ways. So like at a certain point, just stop complaining about it. Either, that's all my point is. It's like my returns and your returns, we're in the same two positions, are completely different right now.
Totally.
So it's just something I wanted to point out.
And let me dig into that a little bit more. There are two things here that we're talking about. Number one is the knowledge of the actual thesis itself and saying what's happening in the macro regime, what are the bets, how should we think about it? The second part that James is talking about is how do you develop the self-confidence, agency, and independence to execute on that? And that really connects to why myself and James do these live streams, because I'm going over all the information knowledge side of markets and how do you connect that to the macro regime and these big bets. James, his entire point is to be able to say, okay, we have that knowledge. Let's go work on the biggest thing that's going to get in your way, which is yourself. And let's talk about how exactly we can do better at, getting out of your own way and being able to have a clear decision-making process. And the entire point of what his channel is, you should just go to YouTube, go to James Rosenthal on YouTube, is to build a foundation and a framework around that. If you think that you're just going to, in the same way that if you think you're just going to, become an expert in stocks, interest rates, and FX overnight, if you think you're going to develop, a process of confidence and emotional clarity and mental stability overnight, right? That's the type of position where you're just going to get into a lot of trouble because you're overestimating your own abilities, which means that you're probably going to go into, a place, you're going to put more weight on the rack than you can handle. You're going to try to bench it and it's going to crush you. And then you're not going to be able to get up you're going to get injured and you're not going to be able to do anything, right? And you're going to get your confidence broken down so much that if you just took incremental growth, then you probably would have been farther along. And so I think that's just, really key point that you really cover in a lot of your videos that I think is just really critical.
Yeah. And I'm surprised you're able to pull that analogy together since you've only ever been able to do a bar push-up. Like if you're going to get on the bench, I've never seen somebody.
Well, I can't reach the bar. I'm not tall enough to even.
It's like you're the only person I've seen never actually go to grab the weights on the back. You just are like, hey, the bar's good enough for me. Crazy.
For anyone who doesn't know, I'm 4'5", and James is like 6'3". No, 6'4". Wait, are you 6'4" or 6'5"?
I mean, look, when you're that tall, does it really matter? It all kind of blends together, right? It's just the same thing if you're under 5'8". Like, what's it matter, right?
It's true. It's true.
5'4" and 5'5". You're all the same person, right?
No matter what, you have a small person. What is it? Small person confidence or whatever it is.
Yeah. What's crazy is like for Halloween, you could actually go as like an end table, right? That could be you. And I could never do that. So think about how amazing that is for you. You could actually be a side table for Halloween. That's crazy.
Exactly.
And I could be a floor lamp.
Just a nice pristine one right there.
Yeah, this is how we get into Kevin Warsh speak. This is exactly what they discuss.
Let me tell you guys something. We are going to make the Kevin Warsh speech have a lot more vibes than even he did. I will say this. Okay, we're gonna jump right into it. I will say this. I think I'm super excited to have Kevin Warsh as the Fed chair, just because I think he is going to just crush, and he gets how the system works. And I actually think that he had a little bit more authenticity than Powell in the speech that he had yesterday, and I just liked how he was actually sharing what he was thinking and not just playing all the corporate talk that everyone plays. But that's what we're going to go over in the slides today. Again, if you were here, go to capitalflowsresearch.com. Everything is sent out there every single day. If you want this slide deck, it's there. And the framework for what we're going to go through today is I'm going to walk you through Kevin Warsh's ideas. We're going to connect it. I'm going to explain how it works, and we'll connect it to charts. And then as a reminder, for anyone that's watching this, we will, James, we're doing a stream right after this, right? Can you talk about that? We'll do a stream right after this on your channel with you, me, and Alfie.
Yeah, we're going to do a stream. It'll be a little bit more just kind of talking about the market melt up, kind of what we're seeing in meme stocks, and just talking more about Alfie and what he's doing. And it just like more about getting into the industry, getting into the space, how maybe we all entered in different ways and how everybody can make it. So if that's something, once your brain is fried from Kevin Warsh stuff, you guys could kind of come over there and just veg out.
Interesting. Veg out.
By the way, can I just mention something really funny?
Sure,
go ahead. Just because Spirit Airlines, I don't know if you've ever seen this stock. It's FLY. It's I can't remember. Oh, FLYYQ. Okay, guys. Yesterday, when Trump was speaking on Squawk Box, they were talking about Spirit Airlines because it's basically dead and like gone bankrupt, and everybody was wondering what's going to happen to it. He says casually, "Oh, maybe we'll buy them." And look what's happened to the stock now, right? And I have this idea. I'm calling it here first on your live stream. I think if they actually were to buy this, he's going to turn it into Trump Airlines. I think we're going to have a Trump Airlines in America sometime soon. There you go. You heard it here first.
How exciting.
You guys could come to America, shoot guns, and fly on Trump Airlines or whatever you want to do.
Are we going to put some money on this? Can we put some money on this? What are we doing?
I don't. What do you mean? Like an over under on how long that takes, or what?
Sure.
It needs a poly market.
Let's create a poly market around it.
I mean, I don't know if it's a base case, so I need odds on Trump Airlines actually becoming a thing. But yeah, I'd probably.
Well, it sounds like there's a lot of vibes going into this, so it's probably going to work. Why are we overthinking?
Probably going to work. See, that's what I'm saying. Is you could do all this to try to get like underread like what forward guidance is going to look like here in the future, or you could listen to Trump on Squawk Box and buy a dying airline.
Yeah, just full port into an airline.
Airport.
If you would have only put $1 million into this yesterday, you would have made 1.5 million right now.
That's right.
It's so simple. I don't know why you're overcomplicating it, James.
I'm not. I'm trying to get people to realize how easy this can be for you. You buy a Chinese cat, you drink coffee, and you watch Squawk Box.
There it is. The vibes. All right. Let's jump into this, everyone. In the beginning of Kevin Warsh's speech, one of the things that he talked about was that inflation is the Fed's choice. And he used the parallel of 2021 and 2022. And Kevin Warsh said, when over the course of the last several years, especially after COVID, when prices went up to the tune of 25 to 30% for virtually all deciles of American people, that's an indication that the Fed missed its mark, and we are dealing with the legacy of policy errors from 2021 and 2022. The fact that Kevin Warsh is calling this out is in itself pretty significant, because he is not just saying, let me fit into the institution. He is indicating regime change at that institution. Once you let inflation take hold of the economy, it's more expensive and harder to bring down. And so the fatal policy error going back 4 or 5 years is still a legacy that we are dealing with. I do think it is interesting that he used the word and language of legacy, because he's basically painting Powell and his legacy as basically failing an error. The cumulative increase in prices started in 2020 till now. It's between 25 and 30%. So that I understand, hardworking Americans are still struggling. The main idea is that inflation is a Fed's choice. And in 2020, as you referenced, with the Federal Reserve change its inflation framework in August of 2020, really key right there. Inflation was running around 1.72%, and the Fed changed its framework, rewrote, and then submitted it. And basically, they ended up with a lot more of inflation because they changed their framework. Now, let's talk about what that looks like exactly. What took place in 2020 when they changed their framework is that you had inflation run way above target. And so you'll notice in green here, there is a 22% real loss. If the Fed would have not changed their framework and kept a 2% target path instead of, broadly 2% or whatever they were talking about, this is the spread that you would have seen during that time. Or this is the spread that you basically had take place during this time where we ran above inflation. So if they would have stayed there, we wouldn't have had a 22% loss in markets or in inflation and in real purchasing power. And here's another chart of that, where there is now a permanent gap in CPI versus the 2% target trajectory. And here is where the CPI index is, and this is just the outright index as opposed to the year over year change. But the outright price level here in CPI would have been down here if we just had a 2% path. So this entire period right now is what Kevin Warsh is talking about a policy error. And this is really indicative of the fact that, you have in August of 2020, when this was adopted, this massive spread now. And so when you have these types of periods where you have inflation run above target, the net result is a pretty big impact on working class people. And, Powell has kind of tried to play around that and never called it a policy error. And Kevin Warsh is basically saying this was a massive issue. Look at where we're at now. Massive loss that has taken place. The other thing that he talked about is a new framework, new tools, new communication. And this is going to be one of the biggest changes that Kevin Warsh talks about. And I'll connect this to some, really interesting visuals that will help you understand this. And he says, we need judgment and fundamental policy reforms, new framework, new tools, and I also say new chairman, new communications. I also think that means that regime change in a conduct of policy. I think this means a new and a different inflation framework. One of the things that you really need to understand during this time is that there are several things on a structural basis that create regime change. One of them is regulation, which changes how capital flows through the economy and markets. The other one is fundamental shifts in how people are interpreting data. So, maybe we'll have some new data sets under Warsh and things like that. But overall, what Warsh is saying is that I am going to shift the interpretive framework for action in how we're interpreting inflation. And so this is as consequential a moment for the U.S. economy and, frankly, for the institution at any point since the 1970s. Status quo practices, Kevin Warsh says, are essentially harmful when the world is changing this fast. If confirmed as chairman, I will be faithful to the Constitution, to the Federal Reserve Act, and to the very best of the Fed's traditions. I believe in reform-oriented Fed can make a difference for the American people. Milton Friedman had a phrase that always stayed with me. He was always worried about government officials that lured and hung around with what he called the tyranny of status quo. The idea behind that is that everyone, in kind of the same way of a corporate job, everyone's just trying not to rock the boat so that they preserve their own ability, their self in whatever they're doing. So when you have this new framework, these new tools, these new communication, it is shifting the regime that we're in this period of time. And so the idea is that you had all of these different Fed frameworks during different Fed governors. You had, during a long period of time previously, the main one that people talk about most is Volcker, Greenspan, Bernanke. Yeah, no one really talks about Yellen because what did she really do? I think she got more publicity under being a Treasury secretary. I think that was just because we were in the meme economy at that point. But the idea is that, Powell, the entire period of time is that you had this certain inflation framework under him. And when you have regime changes in Fed governors, you have regime changes in how they interpret data, which directly inputs how interest rates change and thereby how you have money flow through the economy. So I think this is going to be one of the most important things that you can understand during this period of time, because it's going to shape how the forward curve prices interest rates, and also how we're going to have interest rates move across the risk curve. And so if you are kind of brand new to how these types of regimes work or how interest rates function, here is what I will say about this is interest rates are the asymmetrical linchpin on which the entire economy turns. And if you don't understand interest rates, you are always going to be at a disadvantage. Always be at a disadvantage, no matter what. Now, that doesn't mean you can't accomplish anything, doesn't mean you can't take risk or anything like that. But the entire point about understanding interest rates is that they are the net expression of money in the system. And one of the things that, I go over the most is in this, model that I break down everything for interest rates. We go over nominals, reals, and inflation swaps right here all the time and explain, okay, how are these functioning in the regime right now? And one of the main things for the credit cycle melt up that I've been laying out in live streams over and over is directly connected to 2-year real interest rates and the fact that they've fallen so much. And so if you have this shift in the Fed policy and how they're going to react to things, that's going to change where we're at with inflation expectations. You'll notice that, inflation expectations have likely made a peak here for the 2-year. And the question is, how is the Fed going to respond to that? And I think one of the hard things for people to understand is that the Fed's actions in itself through these different regimes are a direct input into how inflation will play out. So it's not just how is the Fed responding, but how is the Fed influencing the actual outcome of what is taking place? And you can see here that over time, you have the inflation, and then you also have the effective Fed funds rate in orange. And you can see how you have a different spread between them through different periods of time. And so this will be one of the most important kind of charts to think about as we move into the next 3 to 6 months, where Warsh begins to take a lot more control of what's taking place. The next thing that I want to cover on Kevin Warsh is how he thinks about these new tools that he has and how it connects to the economy, how it connects to interest rates, how it connects to the forward curve and things like that. Warsh said, the interest rate tool gets us into the cracks. It's fairer. The balance sheet tool is disproportionately helps those with financial assets. This is one of the things that, I've talked about so many times on live streams and also in videos, that the Fed, when they expand their balance sheet, that is not helping the everyday American. That is only helping those with financial assets and the top, 50% of people who hold assets, and really the top 1% of people who hold a ton of assets. Warsh said the Fed has an interest rate tool and a balance sheet tool. My view is that the interest rate tool gets in the cracks. It's fairer, but the balance sheet disproportionately helps those with financial assets. The interest rate tool hits the entire economy. Now, the reason why that is the way it is because when you think about interest rates, that impacts all of our abilities to take out mortgages, to take out auto loans, to take out small business loans and things like that. When you think about the balance sheet, that primarily impacts financial markets and liquidity in the system. And when you don't just have the balance sheet and interest rates move in lockstep, when you begin to, the entire point of Kevin Warsh here is that we can cut interest rates and decrease the balance sheet at the same time. The decrease in interest rates will help the economy, and the decrease in balance sheet will help offset some of that and maybe on net keep the market flat. So that's an important scenario, thinking that you want to think about when we move forward. Because, for example, if you haven't already, one of the things that I map in the S&P 500 is what's the impact on interest rates right here. How does that connect to the forward curve and the changes in things like ZT or UB on the long end? And the idea here is that when you have the Fed balance sheet begin to contract, but then you have interest rates drop, you have two different mechanisms that are pushing liquidity and taking liquidity out of markets, but one is directly helping the economy and people in that economy. And so I think we're going to see a very interesting new liquidity framework that I think a lot of people are frankly not really prepared for. And, the move that we are already seeing in interest rates is actually connected to this credit cycle melt up. So I think one of the things that's going to be interesting is how much of the balance sheet do they need to take off in order to put a cap on equities? Because Warsh knows that we're at all-time highs in equities. I do think it's a little ironic if, Kevin Warsh is probably going into cash right now because he's becoming the Fed chair. It'd be very ironic if he crashed the stock market by collapsing the Fed balance sheet, not cutting rates commensurately, and now he's all in cash within the first 90 days, right? It would just be kind of funny. I don't think, we'll see what ends up playing out. But, equity's rallying right now. I mean, I covered this all for paid subscribers. Everyone said, oh, look, we're at an all-time high right now. It's a horrible time to buy equities. And then NQ just keeps melting up. Why is that? Well, part of it is because IGV is also up, and you also have the tech sector up so much. And again, over and over, I've laid out, this is not the time to be cute with assets and try to short the S&P or try to do something like that. My entire view is being long Oracle, long Per, long hype. And, I still think Bitcoin is going to move up. We're already seeing it move up on the day. And all of these changes in what Warsh is going to do is going to reverberate across all these assets. So here, when, you have Warsh making these comments about had the balance sheet not been brought from 800 billion level to when I showed up at the Fed in 2006 to an order of magnitude higher, if the Fed had kept a smaller balance sheet, I think interest rates could be lower, inflation could be better, and the economy could be stronger. The transmission mechanism for a large balance sheet goes both ways, signaling effects through asset prices were at zero. But in an ordinary course, the central bank and independent body should be adopting. Oh, you know what? I didn't read this properly. The transmission mechanism for a large balance sheet goes two ways, signaling effects through asset prices. Now, at a time of financial crisis, financial asset prices were down 60 to 70%. What is going on here? And so it was understandable that interest rates were at zero. But in an ordinary course, the central bank should not be adopting a set of policies that has that kind of distribution. So basically what he's saying is that we shouldn't just be expanding the balance sheet for the sake of expanding the balance sheet, which is what happened under Powell. And, in my view, Powell, even though we avoided a lot of things, he created inflation. The Fed's choice and input was a direct input into inflation. And so half of our fellow Americans don't own any financial assets, Warsh said, and they're wondering what's in their future, right? What's in it for them? And so the Federal Reserve, I believe, is going to obtain a lot of credibility because they're going to actually help a lot of Americans if they decrease interest rates and decrease the balance sheet. And what does that look like? You can see here the QE spotlight. What begins to take place is that when the balance sheet increases, who does that help? Balance sheet, asset prices, financial assets, those rise. And the top 1% or top 50% of people who hold assets, they're the ones that benefit. And then you have everyone else who is not benefiting from that when you have the Fed balance sheet go up. On the interest rate side, over here, interest rate transmission mechanism transmits into mortgages, small businesses, housing demand. It also transmits into auto loans, auto sales, hiring, every single thing, layoffs, fuel costs, everything, the rental market, gig work, bonuses, hours worked. Interest rates transmit into all of these mechanisms in a way that the balance sheet doesn't. And the rate tool reaches 340 million Americans. That's the entire point of Kevin Warsh right here, where he's shifting the entire framework and saying interest rates impact this side of the economy, whereas QE and balance sheet impacts primarily the people who hold financial assets. And this really connects into this broader idea that, myself and James have talked about, where in the economy overall, the way that you need to think about the world that we're moving into is you need to think about the macro environment and risk taking, because the market and the economy is pushing you to be more and more aware of these macro changes. Because if you're not taking risks, if you're not obtaining financial assets in some way, then you're going to have the deck stacked against you, which just means that the only way that you can move forward is by developing some type of specialized knowledge somewhere. And so I think that it's very difficult for people, James, you can speak to this a little bit. It's very difficult for people to look back and say, well, my parents or the boomer generation, all they needed to do is work a 9-to-5 job. And then, they were fine. They were able to buy a house, do all this other stuff. And the world changes, right? I think that you actually now have a higher probability of making more money than your parents if you actually change in lockstep with the economy and you actually have a stance toward the economy that is more risk-taking. And if you take just a little bit more incremental risk, you can be massively more wealthy than your parents who just had this whole entire pension and 9-to-5 framework. And I think, James, you've talked about that kind of idea of risk-taking and how important that is in this period of time. How do you think about that connected to this idea of interest rates, balance sheet, new regime? I mean, how do you think about that a little bit?
I see that once you mentioned boomers, you decided to come over to me. So that seems about...
You're a boomer, right?
Seems about right.
You're super old.
Yes, I'm 67 now. So getting up there. Yeah, I think it's like, we talked a little bit about this idea of like the capitulation moment for the K-shaped economy. You remember that? Like where like it kind of seems like this linear K, right? But then at the end, when there's like this moment where like all of the assets kind of boom towards the top and the like lower ones gets worse and worse before there's like a, people talk about a revolution or whatever it might be. I think about that a lot. And I think about the idea that, like you're saying, you have the opportunity right now to look at the face of risk and volatility and move towards it and actually cement yourself into that upper echelon easier than it's ever been before. But everything is set up for you to ride the bottom of the K, which seems much easier and safer and less volatile, but that will collapse you into the ground if you let it. So I think there's just a moment in time where you have complete autonomy over deciding where you want to be. Now, of course, Kevin Warsh could come in. We could all get all hyped up about how he's going to like rebalance the situation. It's going to be great. But I have to say, like, looking through all of what you just covered, like, sounds awesome. Like, it sounds so dialed. Like, he's really hitting out all the points that people really worry about, and like setting up, like, he's alley-ooping himself by saying, like, he's not leaning into some sort of QE mindset. He's saying that's actually what got us into this place, but there's new tools. We're going to communicate better. It's going to be like, he's already dulling the blow of markets saying, well, wait, he's not going to do QE. Well, we're fucked. He's projecting out like a lot of buffer and a lot of like kind of cool stuff. So, when I see it, I'm excited to see how this transition happens. Will it actually change the game for this specific situation here? Yeah, like, yet to be seen, but the opportunity lies there.
Yeah, I think here's the way that I look at this. A lot of people look at this and then think like, oh no, I don't know if this is going to help me or hurt me. And when I see this as a trader, as a risk taker in life, as, a business owner, as everything, I look at this and I just say, if there's change that's happening in the world, all I need to do is figure out how to be on the right side of it. Because I said this earlier, volatility exists to take money from the weak and give it to the strong. So when you see change, when you see stuff that's going to change, you should be excited because you say, oh, wow, there is going to be an opportunity to adapt that I know other people won't take. Perfect. And that's the risk-taking mindset. You know what's actually kind of funny is you have this entire gap generationally, and you have all the boomers who were less risk takers because they got their homes, they did their thing, whatever. Then you have the millennials that just looked at them and were kind of pissed off no matter what. And then you have, some people that were kind of, weren't able to get there, or whatever you want to say. But now what you're having is this entire new generation of kids who are growing up on betting markets and playing cards and NFTs and, crypto. They're learning how to be risk takers in life. And so they are going to benefit the most in this period of time because they're just risk takers. And everyone keeps complaining about looking to the left and looking to the right and saying that person has it better off than me. That person is better than me. I'm not as good as that person. What are you doing? And people are going to come up with all these excuses or whatever it might be. You just need to come back to this idea of there is more opportunity in today's world than there was 40 years ago. There's more opportunity in today's world than there was 20 years ago. And there's more opportunity in today's world than there was 1 year ago. Because we are seeing so much change happen faster and faster and faster, which means that the price that the market and economy pays for agency and accountability is increasing more and more and more, which just means your ability to become exceptional relies more and more on you. And so I just think that understanding that framework for accountability and agency and then overlaying it with this larger regime shift that's happening is going to be absolutely critical. Here's another chart of kind of this idea of the QE transmission mechanism. And you can see how the balance sheet right here and the S&P 500 overlap. You had the balance sheet rise as it set a bottom in equity markets. And, by the way, actually in the balance sheet, if we even dug into it more, the thing that really set the low in the balance sheet, by the way, little anecdotal thing, if you go to the S&P 500 on the intraday low that it had in the bottom here in 2008, the exact intraday low was 666. Just saying, go check it out. I'm not making it up.
That's why we're going to have a high of 8888. That's what the SPX is going to be there. It's going to be the Chinese, good luck or whatever.
Yeah.
Or maybe the Messiah returns SPX 10,000. Right?
It's very possible. It's probable, actually. It's actually certain.
A peak too. Yeah, it'll be a peak, which will be like the mount. What was the mountain he's supposed to come back on? I don't know.
Mount of Olives. Mount of Olives. Come on, James. You're reading the Bible. Okay. You should know this.
So you're going to need to have a martini with an olive at SPX 10,000. I think that grants you access to heaven. I'm pretty sure if you don't partake in religion, but you have a martini with an olive on a hill while SPX hits 10,000, that also grants you access.
Right. That's in 2nd Hezekiah, right?
I think so.
See, if you read your Bible more, you know that's not a book.
Oh, man. It's in Reputations. Is that a book? Reputations 3.
It's okay, guys. We're working on James. He's reading the Bible. We're making progress, okay?
Guys, I've only had Exodus. All right? Jesus.
All right, guys. So back to the chart here. So balance sheet up, balance sheet rising. I mean, here's one of the things that I don't think everyone really got very well. In 2021, the balance sheet was literally expanding into one of the largest growth expansions in the reopening of the economy in history. And they were expanding the balance sheet into it. I mean, what do you expect to happen? We still have a balance sheet at $6.1 trillion. It's massive. It's still pretty significant. And so that on net has allowed more money to stay in financial markets. And that's one of the things that I think Kevin Warsh has, at the very least, some intentionality to change. If you begin to change that, that's going to change how liquidity flows through the system, which is why trading markets and understanding liquidity during this time is so key. On the
could you go back just real quick to, again, visually, when I look at that chart and it's curling up like that, I'm like, okay, at worst, that's probably going to trend sideways, right? At worst. Also,
Right.
they're probably going to expand it over time for whatever reason because they just do. But like when you look at that chart, I mean, how could you be bearish? Like, how could you be bearish? Look what happened in. I mean, I was trading 2020 or sorry 2018 when they tried to like draw that thing down.
Yep.
Dude, you should. I don't know if you were in markets at that time. I don't really think you were. I think you were working either in real estate or whatever. But like, that got crazy, dude.
Yeah.
That got absolutely nuts when they tried to tighten things up. And I think the markets know so much better now and are so much like more, able to like move money around at the speed of light or whatever, that if they tried to do that again, like the reaction function would be like so violent that like I just now if that starts to curl up, like how could you that visual is just so powerful right there.
Totally. No, I think that was something that people weren't expecting in 2018. I remember it just beginning to push people off sides a little bit. And I think there was a lot more focus on like, why is the Fed doing this stuff right now? Why doesn't the Fed have our back? Right. And what I would say is, Warsh is going to be a lot more intentional in, I think I have a slide in here where he talks about working with the government, but independent of the government. And the entire idea is how do we work with the Treasury to accomplish this stuff while still maintaining our independence, right? And I think that will be a very interesting thing to see how they thread the needle with Scott Bessent. I think it's this slide, or maybe it's the next one, where, again, this is also in the balance sheet where he talks about it took us 18 years to create a big balance sheet that it's done quite a bit of harm. Oh, yeah, here it is. Working with the Treasury Secretary, we're going to have to find a way in which we can have the balance sheet and make it smaller, because a large balance sheet where the Fed owns more outstanding debt than many parts of financial markets, that's fiscal policy in disguise. So, Warsh is very clear that he wants to have a different stance. He wants to work with the Treasury, but they still want to have their own goals and be able to work through that together, which it's very clear that, Powell and Scott Bessent are not on the same page. And so I think that is going to be a big shift in markets where they're going to be able to coordinate things a lot more. And then, when you think about the balance sheet reduction and where it's at, it depends on, one, what elements are they going to remove, how fast or slow that's going to take place, and when, you have something in the market break or not break. And so, it took 18 years to build it. You're not going to fix it in 18 minutes and really just flow it around immediately. But there'll be a lot of discussion around how they're going to shift the balance sheet from here going forward. And I think that's going to be one of the things, because he's now changing. Powell always talked about, well, the fiscal side of things is not something we comment on because we don't comment on this or that, right? But they say, but they need to fix things. Warsh is saying, how do we have a better stance toward all these things that are taking place? And that is going to be one of the key things that I think is very interesting for how the Fed functions. This chart here is going to be a really important one to watch, because when you have these changes of the Fed balance sheet relative to the share of outstanding debt, when that increases, that is one of the things that really shifts how money gets monetized in the system and how debt gets monetized and how liquidity enters or exits the system, which is why the dollar is so important to watch right now. So that'll be a thing that we cover a lot on the Substack as we move forward. Next thing, War says, I believe.
Can I real quick added something
Please,
there,
yeah,
just as you switch over? Can you feel the build of the people getting more intertwined and like sharp? Like, to me, it's like these people would come out of nowhere, right? It'd be like, who was the dude? Mnuchin back in the day. You had like Yellen and her snowball head come out of, and then you had Jay Powell, and there felt like this, they were all in their pockets, their niches, and they had their 30 years of experience or whatever. But now we're shifting into this like Warsh and Besant and like whatever you want to think about Lutnick or whatever, but like these people are dialed in. They know everybody in the space. They know each other. And there's this cohesiveness starting to form that is hard for me to bet against, if that makes sense. And I don't know what that means, but it just feels different than the last 10 years from what I've seen, where they're complete separations and disagreements and all that.
I agree with that 100%. I think that here's the way I like to frame this. You have one of the best money managers in history at the Treasury. You have one of the most successful asset managers in history. I know people don't like Howard Ludnick or whatever his name is. And then you have one of the most accomplished and well-informed persons on international flows, which is Kevin Warsh. And then you have a lot of other, pretty heavy hitters in the entire space. You want to bet against those guys when they're all working together? Like that's what you're coming up with? Like, oh, these guys, let's bet against them. That's what you came up with.
No, dude, like my Twitter timeline tells me that I should. So
it's people who are, it doesn't even, I don't even care if you're, conservative or liberal or whatever, man. Like, this goes back to this idea. I love this idea in The Art of War, where, you should, basically have respect for your enemy. And if you are not respecting him and underestimating him, your demise is certain. And when I see people coming across the timeline and all this stuff and just saying like Trump is stupid, Besant's stupid, Kevin Warsh has no clue, all these people coming across the timeline in this way, I'm just like, it just sounds to me that you're, even if you don't like them from a political perspective, it just sounds to me that you're underestimating your opponent then. That's what it sounds like to me. So I don't even care if you don't like him or not. Just have some respect for who's, especially for someone who is so accomplished as a risk taker. I mean, here's the thing. If George Soros, I don't like George Soros politically or anything like that, right? Obviously, I'm more conservative. But if George Soros was there, I'm sure I would disagree with most of his policies, but I would not underestimate that guy. There's no way, because the guy's a savage. So again, it's this lack of humility that will result in a one-sided thinking and result in blindness for the scenarios that are possible. And eventually what that will do is it'll inject an inability to have feedback in your, mindset, and you'll not be able to see the market clearly over time. And that's why a lot of people will just shift to, let me just shift to systematic or quant strategies or whatever, because then I don't have to think about the world, right? And the entire point is that there's a lot of information in markets, especially in macro, that if you spend time thinking about it from a clear perspective, you can build a massive informational edge. And I see that over and over and over, every single month, every single quarter, every single year. And I think that'll just be a big thing moving forward.
You really hit that home. All right, now let's move on. All
right. You wanted to stop on that slide. You're the one that's slowing me down right now. Okay?
Hell you.
All right. I prefer clean memos and messier meetings. One of the things that he talked about was he doesn't believe in forward guidance. Unlike my colleagues of the past or present, I don't believe in forward guidance. I don't believe that I should be previewing everything for you, what a future decision might be. I think it's essential that in the room. And, he thinks one of the reasons after making a mistake in 2021 and 2022, the mistake was compounded in the Fed giving forward guidance. The Fed tells the whole world what their dots are going to be, what their forecasts are going to be. Well, the Fed's human. They need to hold on to those forecasts longer than they should, or what they do is they hold on to those forecasts longer than they should. I think if the Fed were to wait until it gets into the meeting before making a decision, that incremental deliberation can keep the central bank from compounding its errors. I totally agree with this. Interest rates need to be forward-looking, not based on better data. By the way, right now, my entire view of the credit cycle is based on a policy error. So it's the fact that the Fed, they continue to lag in the data and say, well, we're just going to wait and see. Inaction in a dynamic world is an error. When you are not taking action, it can be an error just as much as taking action can be an error. And this is actually something that, James and I have talked about with a book by Rich Giovanni called Masters of Uncertainty, where he talks about when people face fear. He's a former Navy SEAL, really good, one of the best books I've ever read on how to manage uncertainty. One of the things he said is when you feel uncertainty, you do one of two things. You panic or you procrastinate. You look at the uncertainty and you say, I just need to take action. I have to do something. And then that amplifies the uncertainty because you're panicking. The other thing is procrastination, where you see uncertainty and you say, you know what, I just want to ignore it for now because I don't want to think about it. That also amplifies the uncertainty because you're just not taking action. And so the entire goal is taking strategic action consistently toward the direction, path, or destination or outcome of the uncertainty that exists, and creating micro goals in that process and incrementally being able to do those things. And so that's the entire focus of Kevin Warsh, where he doesn't want to have this forward guidance that has this linear thinking, but wants to have, messier meetings, probably more openness to that, and not these same forecasting errors that are causing a lot more issues in the system. And so if you look at, well, what are the forecasts versus what actually happened? They're always massively off. I mean, here were the forecasts for inflation before the hikes took place. And then here's the first forecast of hikes. I mean, and then here's where we ended up. I mean, where do you come up with that? It's just insane to me that this is still happening. And forward guidance used to never be a thing. I mean, if you talk to any interest rate traders who are around, I mean, obviously forward guidance is more recent, but if you talk to any rate traders that were around in the 70s and 80s, I mean, that period of time was even more interesting because you just had sometimes, the Fed just come out and just throw things into the market. And there was a lot more uncertainty. And I think that you need more, uncertainty around things like that. So you have more premium in the market. And that's why you're having markets move around on his speech a little bit, so that it can account for the variance of errors in the outcome. And it's having that humility. And so Warsh, because he has been a risk taker, he managed money for Druckenmiller. The fact that he did that is in itself going to shape how he views the Fed, because the Fed is an agent in the economy. And so when we think about how he's going to respond to that, one of the things that he talked about is that there's a difference between the change in process, a change in prices and inflation. When inflation moves up, that's because the Fed has done something wrong, or that has something to do with it. That's a fundamental shift in the framework. And he's taking more accountability on the Fed. The data that's being used to judge inflation is quite imperfect, Warsh says. Among the projects of the economics profession, I'm confused. If I'm confirmed as a chairman of the Fed needs to do and try a new understanding of data sources to see what really inflation is in the economy. They talked about, we use core PCE measures, so we'd exclude food and energy because it's a sort of rough swag as to what is actually going on. We don't have to do, that kind of rough understanding anymore. What he's interested in is understanding the underlying inflation rate, not what the one-time change of prices because of a change in geopolitics or a change in beef. What's the underlying generalized price change in the economy? So that shift in inflation framework could really shift how they're mapping these things and say, you know what? Even though oil prices are higher, we want to cut rates. And so the measures he prefers is looking at things that are called trimmed averages, where we take out all of the tail risks of all the one-off items and we ask ourselves whether the generalized change in prices has had an effect on the economy. So it's taking out these more volatile sections and looking at the trimmed measures. And if you want to know what that looks like, the idea is that you have all these inflation data points across where we are. And he's saying, let's take all of these and trim these out and then look at the signal in the middle and have the central bank really focus on that. And so you can see, headline CPI right now is about 3.3%. Core is 2.6. the trimmed mean is 2.7. That's kind of what he's talking about. And so you want to say, what is the actual inflation in the economy connected to demand as opposed to all these supply chain shocks? And that will be a new way that is going to impact price action, impact equities, impact all these things. And it's going to be a very new shift in how we're thinking about inflation. And, here's just kind of another chart of how you want to think about that. Even more recently, you can see 2% target right here. Headline CPI has spiked up on the oil shock a little bit. Core is still down. Trimmed inflation is still pretty low. And we still have an inflation problem because we're not at 2%. But if you're just looking at the trimmed CPI or median CPI or whatever you want to call it, we have not really ticked up. And so that's the entire idea of looking through these energy prices, even though those energy prices can impact the economy. And so if you can map if inflation is creating demand destruction. So for example, when you have inflation rise, when you have oil prices rise, that hits a consumer. Let's say I'm just like a normal person who am impacted by gas prices because I'm driving every single day to work. I think I barely drive my car these days, but let's say I have that in my life. Then what begins to take place is I have a decision. I either have to increase my income and figure out how that gets increased, or I need to spend less money out at food or clothes or, utilities, or turn off the AC more or something, and be able to spend less money. That's demand destruction from inflation. And that can cause people to get laid off. If everyone starts paying more money in gas prices, that can cause destruction in the economy that results in issues across the risk curve. And so this is going to be one of the important things that he talks about and he focuses on as we move into this. And so this goes back to this idea of where does inflation come from? And a lot of it he talks about is connected to the Federal Reserve and also inflation connecting to the government spending. And this is
Can I
the
ask you
idea.
a quick question before
Yep.
you move on to that?
Yep.
Would an example of the trimming situation be like when owner's equivalent rent was like a massive like a tail impact or whatever of the numbers? Would it be? It could be like a changing tail, right? So like the oil shock could maybe be a tail, or owner's equivalent rent could be a tail, or whatever. They're able to just like unweight those and like go with the median. Is that another example of what that would mean?
Yeah, I think the owner's equivalent rent, if we're just having a seasonal or data discrepancy, they would look through that. But owner's equivalent rent is very connected to kind of these core measures of how inflation works. And so I think it would really depend on how they're deciding to look through certain elements. If they know that more houses are coming online within the next couple of months and it's going to push rents down, then they're going to take action based off of that. I think the entire point of Kevin Warsh is not just one data point for inflation, but it's that just think about owner's equivalent rent. If you have a bunch of supply coming online and you know that rents are probably going to fall in 3 months, but it's not reflected in the data, then you're going to take a bet on the future. Like, right, in the same way we do. We're like, oh, I think there's going to be more houses coming online. I'm going to wait 3 months to buy a house because prices might come down a little bit, right? And you're taking a view on the future that is uncertain and not reflected in the data. Whereas the Fed right now, they will say, well, we don't know what's going to happen in the future. We're just going to wait till it's reflected in the data, even if they know, or they have a 80% probability of knowing that more houses are going to come in onto the market in the future. And so it's more about this shift toward a view of the future and future uncertainty, and really the Fed is going to start taking bets on the future more, as opposed to just lagging in the past and always having kind of this backward looking mindset. I think that's the idea, if that makes sense.
Yeah. So everything feels like it's going to be more real time. And given that I'm going to guess there's going to be a lot of communication between Trump and Warsh, I would expect there to be, like when it says like new forms of communication, I would expect us to be seeing a lot more of Warsh than we do of even Powell. Is that what you think is going to happen as well?
I'm not sure on that, actually, because I don't think Warsh likes forward guidance. And I think what they're going to do is I think he's going to build out some more. Here's the thing. This is a total guess from my side. I think Warsh wants to have less governor speaks, and he wants to have more focus on signal. Because right now we have governors that come out every week and just reiterate something or talk about something. Mm-hmm. He wants to say, let's get a better view on everything that's happening. Let's get better data. And then let's talk when there's something to talk about instead of just talking for the sake of talking. So I don't know what that looks like for him. I don't know if that's it could mean that he's not going to speak as much as Powell, right? I'm not sure on that. What I will say, though, is I would not be surprised to see Kevin Warsh shift a lot of the budget at the Fed for how they spend money, create some new data sets, and create a real-time dashboard on the Fed website that's actually real. I mean, if you go onto the Fed website, what is going on there? Like is it the 1990s? Like what's going on, right? Like what are these data sets? Whilst all of us are using real-time data sets that update every single day to price inflation across all these metrics, where people are monitoring credit card data, monitoring prices across Amazon in real time, monitoring hotel prices, food prices. A lot of people have alternative data from grocery stores that show food prices every single day in real time. It's such a massive divergence. And remember, Warsh is from the world of risk takers and hedge funds. So he knows how all of this works. And I think he's going to shift that so that he can actually, I don't think he's going to just bully the other Fed governors. I think what he's going to do is create a mountain of evidence that's indisputable and really swing all of them to his side so that they realize the impact of all these changes that are taking place with clearer data across all of them.
Okay. Yeah. Thanks. By the way, I think, I guess one more thought. I think this picture right here, and I'll send this to you later, but this screenshot of trim the tails, I think we'll hear the word. I think you're kind of you're probably right you might be the first. We're going to hear the word trim thousands of times in the next year. So there you go, guys. You want to talk about being at the forefront of something, AI and this whole idea of it's cool. You can start to see how this might emanate through markets and stuff. And I think this visual is really cool about how to think about that.
Totally. I think, this will be one of the main ideas going forward, in my view. On Warsh, I'm going to go through all these other slides a little bit faster. He's talking about the Federal Reserve is independent inside the government, but not independent of the government. So, understanding and working with the president and also working with the Treasury more. So that'll be one of the main ideas in order to increase credibility, not decrease credibility. And so you want to be able to have the Fed not have credibility erode because you're focusing on DEI or ESG or all this garbage out there, but focused on how can we have higher credibility because we work with the president. If you know that the president's going to, attack another country or have some type of, geopolitical strike on another country that's going to push up oil prices, probably really good to know. I doubt Powell knew that moving into it, right? So that's going to be something very helpful to understand moving forward. And I actually think, Kevin Warsh could be a signal for some of these geopolitical changes moving forward if he's in the know and they shift interest rates as a result of that. So that'll be a really interesting credibility thing. And watching inflation swaps and break evens will be a key thing in that. When they talk about AI, I think this is going to be one of the most interesting things. 2 years from now, we're going to call it, business CapEx. And 3 years from now, we're going to call it just ordinary business of AI. And Warsh is probably the most informed Fed chair on this. Warsh said America's economic growth potential is rising as we sit here today. At a moment like this, the supply side of the economy is drastically changing. The core of what Bernanke said is a question about what the economy's potential is. I think the economy's potential is growing really fast. This is the most disruptive moment in modern history in the U.S. and the world. And all of that connects to the ideas of policy. And so Warsh does want to be able to trim some of these changes in inflation and get in front of this AI disruption dynamic. And if he gets the data sets to do that, to say, we're going to have a lot of supply coming online for labor and goods because of AI and robotics, how do we get in front of that with interest rates so that disinflation or deflation doesn't occur too strong? And so mapping supply and demand of that and understanding how that connects to the AI CapEx wave is going to be really key. And I think that, AI CapEx has gone through the roof, right? As of January 2026, we have over 550 billion. It's more around 660 billion now between all the major companies. And, non-farm productivity could just absolutely rebound in a massive way. So this will be something that we watch very closely moving forward. And Warsh is going to watch as a decision in a very new way. And Warsh is really shifting the idea that inflation comes when the government prints too much and the central bank is too accommodative relative to that. So the Fed, Warsh says, should be open-minded toward all sorts of data, but the things that central banks can affect are the things that are not one-off in nature, but persistent. So very key thing relative to inflation. They can't impact whether oil prices go up once, but they can impact the underlying fundamental things which are connected to demand. And this connects to the Fed impacting demand side of the economy, not the supply side. And so this will be, okay, well, if you have one-time price movements in gasoline or eggs or beef or electronics or something like that, how do we map that and understand it correctly relative to this larger trimmed basket of persistent true inflation? And so when inflation moves up, that's because the Fed has something to do with it. I think that's going to be a key thing of Warsh as we move forward. And here's, just another chart of how you can think about this, where you have core and headline CPI and the divergences between them and how you map the divergences between them. That's going to be a really critical chart moving forward for Warsh. Extraordinary measures in extraordinary times is what he thinks. My criticism about the conduct of monetary policy is in normal times. So Warsh is talking about, hey, in crazy times, yes, you need to really pull out the fire hose and open it up. But when we're in normal times, you need to really shift how you do policy. And I think that's going to be one of the key things, is that when we have extraordinary times, you're still going to see them, really, throw the sink at something, but they're still going to shift how they conduct monetary policy in normal times. And I think that's going to be one of the critical factors and differences. So understanding how much crisis do we have, and kind of this idea of a crisis meter, and what element of stress and what degree of stress do we have in the system is going to determine how much interest rate stress or hikes or cuts they're going to do in their toolbox. And so watching how the GFC, the Euro crisis, COVID, regional banks, how all of that connects is going to be a very critical thing moving forward. Now, what I would say is the most important thing that he did cover was this idea of the dollar is the linchpin of the global economy. My view is that the dollar is heading lower into the end of this year and over the next several years, because the dollar is one of the key things that Bessent and Trump and Warsh understand very, very well. Very well. The dollar is a linchpin in the global economy, Warsh says. The United States and Federal Reserve is the beneficiary of the strong dollar. The U.S. financial system is the most important financial system in the world. Deliver stable prices, deliver an economy that improves from here even further, where real take-home pay moves up, where inflation falls, and the U.S. economy growth potential is the best in the world. The Federal Reserve can be working hand in hand with the rest of the government. The Federal Reserve is independent inside the government, but not independent of the government. That's going to be key, because the dollar is going to be a key input into monetary policy moving forward, because, again, I did an entire video on this. The dollar's reserve currency status both helps and hurts the U.S. economy in such a massive way. And it's going to be, I just cannot express enough. If you don't understand the dollar's reserve currency status, the trade-offs of it, how it connects to markets, you need to go through all of the live streams that I've been doing. And especially, the recent one that I did. Let me pull it up. Let's see. In this tab, go to surplus countries, deficit countries, and this video right here. You really want to go through all that because I connect it, the dollar's reserve currency status, to Besant, Warch, and Myron, and how it connects to this larger picture that we're in. And then you also want to connect to cross-border flows. So go through April 16th, April 15th articles and live streams. If you don't understand the dollar's reserve currency status, you're not going to understand why Trump is doing the things that he's doing, why Besant and Warsh are taking actions that they are, because it connects to this entire world that we're moving into. So when Besant talks about this, he understands global capital flows in a way that no one else does. And I think that he is going to be monitoring exchange rates much more closely going forward. I mean, one of the things that I look at for if the Fed is being too accommodative, too restrictive, is FX, is how is the dollar and its correlation relating to bonds, because it's one of the most important inputs that I watch. And so, again, I believe the dollar is moving lower because they want the dollar moving lower so they can rebalance global trade and global capital. And they're trying to offset some of these negative impacts of the dollar's reserve currency status. I agree that they don't have the right, and I think it would be a bad policy choice. That's what Warsh said about central bank digital currencies. I actually agree with this. I don't think that there should be a central bank digital currency in the same way where, they're going to, have it where they can change your interest rate in your wallet or something like that. I think that's really dumb. I think that there is a very clear line that the Fed doesn't have authority to do that. And so I think him, setting that precedent is going to be really critical in how crypto is integrated and that it's a private sector dynamic and it can connect to the public sector, but not to the monetary base that the Fed manages. I think that's going to be key. Stablecoin prices have been rising, and that's going to be one of the main things that grows, I believe. Stablecoin prices actually, I think, are going to rise in so much as the dollar's reserve currency status remains dominant, because global trade and global reserve currency status is one of the main reasons why we've had stablecoins increase. And again, all the stablecoins, what are they denominated in? Dollars, not the Chinese yuan, not the any of these other currencies. It's all in the dollar. Just think about it like this. People say, the dollar is going to zero or lose confidence or whatever it might be. When every other country is creating, and the private sector is creating stable coins that are pegged to the dollar, that just tells you that they care about the dollar and that there is a very important need for dollars in the system. And so, I talked about digital assets as well, that they're part of the fabric for the United States. And I think that this will just create something to integrate even more. Again, my most bullish views on Hyperliquid and the Per Treasury Company. I laid that out at the beginning of this video and the live streams. And I mean, if you don't know my view on Per, where have you been? Digital assets already part of the fabric. We're already seeing stable coins increase in their supply. And you have, Bitcoin price moving in lockstep, which is, I think, a key connection to stable coins. My preferred definition of stable prices is a little different than most academics. I believe that price stability should be a change in prices such that no one is talking about it. That's an old-fashioned definition. So, James, you're going to love this because he's basically saying, what are the vibes? What are the vibes of inflation? New definition. It's all about the vibes.
I love it.
So that will be one of the things that I think we'll be watching a lot. How exactly is the sentiment around inflation? How does that connect to, what they're thinking about for inflation? I think the consumer sentiment surveys will be interesting. I think the Michigan surveys, I think they're trash, but I think we all watch them. But I think it'll be interesting to see if he creates new data sets around that. So, again, here's, Michigan survey, University of Michigan survey. I think we'll watch these a little bit more, but I think they're going to come out with some new data sets. So I think that'll be the interesting things. In economics, focus on the left of the decimal point, not the right. So that means being more broadly right instead of precisely wrong. Call a flag on yourself and correct them fast. Economics is not physics. It's not math. Frankly, most of us ended up in economics we started, as a math major, it was too hard and we ended up in economics. That's definitely true for me. I think the highest level of math I've ever taken is I failed pre-algebra and I never got past that. So what are you going to do? I do think a lot of risk takers, they suck at math and they end up going into economics or markets or something like that.
Were these all quotes from his thing yesterday?
Yep.
I mean, is this the guy like a quote machine? I mean, that first one in economics, focus on the left of the decimal point, not to the right. If mistakes are made, call the flag on yourself and correct them. I mean, that's like such a good trading quote too. You know what I mean? Like, focus on the broader points that make you a better trader, not like some a lot of people think, oh, I need to find the perfect little tick entry or whatever, and that's going to determine if I'm a profit. No, like, so many bigger things determine if you're like a profitable trader. And when you're wrong, being humble and like less, sizing your ego down to be able to determine you're wrong and to correct that and to get out, like, that's just so good. That's
totally
that's what you want mindset wise there.
I agree. I think it's just, again, the mindset shift is everything. I think it'll just be so, it'll impact so many things. And I think that will just continue to help everything overall. And people don't even recognize how all those little things, I mean, just good leadership is going to help everything. So I think that's going to be a really key thing. If Americans that want a job can find a job, then by that Fed metric, we're at full employment. So I think that's a really key shift. It's not about, oh, well, what's the unemployment rate at or what's this at? It's, can the Americans that want a job find a job? Not all these trust fund kids or all these other people who have money and that are not working or whatever it might be. Can people who want a job find a job? Very simple. And I think that'll be a really kind of key thing. Again, I think we're going to go through a period of time where we have a lot new or a lot more data sets that are a lot better. And we will see kind of how these things shift. I think that'll be a really interesting thing to watch. So U.S. labor market, I'm going to do an entire video breaking down the labor market a little bit more. Right now, I think the labor market's fine. We're not seeing initial claims or unemployment spike significantly. NFP, it's kind of at coin flips in terms of expansion or contraction. Just shows that we're not seeing enough contraction. When the Russell's rallying like this and all these other CapEx changes, we're seeing some rebalance in labor, but overall, everything's fine in my view. They asked for a little more inflation. They got a lot more. That's the 2020 framework that happened. And here's pre-2020 inflation targeting, 1.7%. After they changed the inflation targeting, yeah, that's what happened. And we're even still seeing that too today. We're not even back to 2%. So the framework change in itself is because of the Fed. So Warsh's entire point is that this is because the Fed shifted its framework, and that's why inflation rose. So, clean memos, more messy meetings, more divergence in opinions. It's not wrong. That's what he's talking about. He wants more like messy rooms, more disagreements, and I think he wants to bring more transparency into the Fed. Here is, this is a wild chart. Here's how many dissents there are. So think about it. FOMC, you have votes every single meeting, right? Here is how many disagreements there were per year in those meetings. And this is during the, this is when Warsh was around and they had this, period of the 2010s and pre-2008. Here's where we are now. No one's disagreeing. Maybe one person. And we only have two people disagreeing here, or two disagreements, because Myron got in there because Trump put him in there. He's the only reason.
That's wild. That's a wild chart.
Look at you're telling me that, like, oh no, Powell's done such a good job. It's like, it just sounds like he's created an entire, set of people that just don't want to disagree. Just sounds like you want to have trouble there. This chart says it all. It just shows the amount of feedback that you have in the system, and it just shows that Powell has a bunch of yes men around him. Even though he gets up there and you go, oh, no, we welcome disagreement. Clearly not. Like, how do you have so many people that are just saying yes, and then you say you welcome disagreement? And it's just someone coping and then just surrounding themselves with yes men. So when we pull everything together, the main idea of all of these slides is that there is an entire regime shift for Warsh coming in as the new Fed chair. And he is going to dramatically change every single data point and interpretive framework in this. And I think it's going to be pretty dramatic in how things shift. My view is that if you intentionally are monitoring this situation and being able to adapt to these new changes that are taking place, it is going to be one of the biggest differentiating factors, especially as it overlaps with how much change is taking place in the AI space, in the social media space, in the rebalancing the economy. Again, I did an entire video on real estate yesterday. If you didn't watch that, go watch that right now. It's linked yesterday in the Substack. And again, my entire goal is that every single day I'm doing a live stream breaking down everything. And so if you are an individual who says, you know what, I don't want to just sit on the sidelines and be an average. I want to actually take agency, be intentional, and begin to think about the changes that are taking place in the system. And here's the thing. You don't need to agree with every single thing that I say. All you need to do is engage intentionally so that you can come up with your own view and place your own bets. And so every single live stream I'm going to do every single day of the week, 8:30 a.m. Mountain Standard Time. Every single chart deck that I laid out from this slide will be available at capitalflowsresearch.com. So go there. It'll be 100% free. I'll be sending out a market report tonight for paid subscribers, breaking everything down even further. I sent one out last night on real estate that really maps the equity dispersion that we're seeing taking place and how you want to connect it to things. And so the idea is that we are in a credit cycle right now, and we are seeing a regime shift in monetary policy. We need to continue mapping the macro regime. The asymmetric bets that I'm running right now that I've shared with you, Per and Oracle, are the most asymmetric, disruptive plays that exist right now in the market, in my view. And that's what I'm betting on. And so I'm going to continue monitoring the macro regime, continue monitoring those bets, and then developing knowledge to set a stage so that I can take more bets. And so that's the main idea for the live stream today. Myself and James are going to switch over to a live stream on his channel and covering some of these different changes in the charts with myself, James, and Alfie. And we'll be covering things a little bit more, but we're going to do that on James' session. You can just go to his channel. Again, if you are not on James's channel and you're not going through all of his work, let me just pull it up really fast. It's James Rosenthal on YouTube, or you can go to his Twitter account. Again, everything is here. So go to James Rosenthal and his thing. We'll go live in a second on there. James, final thoughts, things that you want to leave us with. What do you got?
I think it was great. I have a much better kind of feeling now towards Warsh. I think that helped a lot of people. So other than that, that's exciting. He comes in when? When is he getting appointed? 2 months?
What is it, June, I think? June?
Okay, so a few months. That'll be here faster than we know, of course. So all right, yeah, we'll pop over there. I'll see you guys later. Thanks for everything, Capital.
Awesome. All right, everyone. I'll catch you on the stream with James, and I will catch you guys on the Substack. Catch you guys soon.